Hello students, welcome to the lecture on analysis of financial statements, and after this lecture we will be able to learn the following objectives. Give details of the concept and objectives of financial statement analysis, describe the types of financial analysis statement, talk about the comparative financial statements, give details of the trend analysis, talk about the ratio analysis. Let us start with the introduction of analysis of financial statements. Financial statement or financial analysis is the process of understanding the risk and profitability of a firm, business, sub-business or project through analysis of reported financial information, particularly annual and quarterly reports. Financial analysis is the selection, evaluation and interpretation of financial data along with other pertinent information to assist in investment and financial decision making. Financial analysis may be used internally to evaluate issues such as employee performance, the efficiency of operations and credit policies, and externally to evaluate potential investments and the credit worthiness of borrowers, among other things. The analyst draws the financial data needed in financial analysis from many sources. The primary source is the data provided by the company itself in its annual report and required disclosures. The annual report comprises the income statement, the balance sheet, and the statement of cash flows, as well as footnotes to these statements.
To start the discussion, first of all, what we have to ask to ourselves is why we do need to know financial statement analysis. Now, there are a lot of reasons, but let's just assume that you're here working in a bank, you're working as an analyst, and the bank basically asks you on a daily basis to look at the share price of these companies, for example, look at their profitability, look at their liquidity, look at their solvency ratio, and so on and so forth. Forget about those sophisticated terms. What these boss actually want you to do is answer this question: should we buy these shares of the company? Or if there's company who asks for loans, should we give them the loans? So this is basically the questions that need to be answered when they're talking about liquidity, solvency, and so on and so forth. How you can do that? There are a lot of ways to do that, but one of them is you look at the financial statements and you make some sort of analysis based on the financial statement. Now, financial statement analysis is basically a small part of business analysis. So if your company probably wants to invest in one other company, you conduct business analysis. If you're working in the bank and the bank wants to give loan to a certain company, you conduct business analysis. So business analysis itself is divided into several terms, several specific goals. Some people say it's a credit worthiness analysis. When a bank do business analysis towards a company, that's called credit worthiness. When there's a other company who wants to invest in other companies' shares, it called equity valuations. But basically, this what is similar is these two business analysis. Both of them use financial statements as their main source. Why do they choose to use financial statements? Is because financial statements reduce uncertainty and increase confidence in
concept and objectives. We know business is mainly concerned with the financial activities. In order to ascertain the financial status of the business, every enterprise prepares certain statements known as financial statements. Financial statements are mainly prepared for decision-making purposes. But the information as is provided in the financial statements is not adequately helpful in drawing a meaningful conclusion. Thus, an effective analysis and interpretation of financial statements is required. Analysis means establishing a meaningful relationship between various items of the two financial statements with each other in such a way that a conclusion is drawn. By financial statements, we mean two statements: profit and loss account or income statement, balance sheet or position statement. These are prepared at the end of a given period of time. They are the indicators of profitability and financial soundness of the business concern. The term financial analysis is also known as analysis and interpretation of financial statements. It refers to the establishing meaningful relationship between various items of the two financial statements, that is, income statement and position statement. It determines financial strength and weakness of the firm. Analysis of financial statements is an attempt to assess the efficiency and performance of an enterprise. Thus, the analysis and interpretation of financial statements is very essential to measure the efficiency, profitability, financial soundness, and future prospects of the business units. Financial analysis serves the following purposes: measuring the profitability. The main objective of a business is to earn a satisfactory return on the funds invested in it. Financial analysis helps in ascertaining whether adequate profits are being earned on the capital invested in the business or not. It also helps in knowing the capacity to pay the interest and dividend. Indicating the trend of achievements, financial statements can be compared and the trend regarding various expenses, purchases, sales, gross profits and net profit, etc. can be ascertained. Value of assets and liabilities can be compared and the future prospects of the business can be envisaged. Assessing the growth potential of the business. The trend and other analysis of the business provides sufficient information indicating the growth potential of the business. Comparative position in relation to other firms. The purpose of financial statements analysis is to help the management to make a comparative study of the profitability of various firms engaged in similar businesses. Such comparisons also help the management to study the position of their firm in respect of sales, expenses, profitability, and utilizing capital, etc. Assess overall financial strength. The purpose of financial analysis is to assess the financial strength of the business. Analysis also helps in taking decisions whether funds required for the purchase of new machines and equipments are provided from internal sources of the business or not. If yes, how much? And also to assess how much funds have been received from external sources. Assess solvency of the firm. The different tools of an analysis tell us whether the firm has sufficient funds to meet its short-term and long-term liabilities or not. Types of financial statements. Financial statements can be referred to as representation of the financial status of a company in a systematically documented form. There are different types of financial statements. Financial statements are required to be audited by authentic, efficient audit firms to avoid manipulation of numbers. Statements are usually audited by the accounting firms after a thorough study of the company records. The accounting and the audit firms make sure that the company is obeying and operating as per norms laid down by the generally accepted accounting principles or GAAP. Basically, there are 4 different types of financial statements. The different types of financial statements indicate the different activities occurring in a particular business house. Balance sheet. The balance sheet provides an insight into the financial status of a company at a particular time. The balance sheet type of financial statement is different in comparison to the other types of financial statements. Other financial statements are prepared by taking into account the financial health of the company over a considerable span of time. Income statements. It is also known as the PLN statement or the profit and loss statement. This statement ascertains the profit and loss of any business. This can be again of 2 types: single-step income statement, multi-step income statement. Statements of retained earnings. This financial statement denotes alterations in these rights of equities in any business. Cash flow statement. This statement highlights flow of cash over a period of time. The cash flow may be from investment activities, operations, or financing activities. Comparative size income statements and balance sheets. Comparative balance sheet. The comparative balance sheet shows the different assets and liabilities of the firm on different dates to make comparison of balances from one date to another. The comparative balance sheet has two columns for the data of original balance sheets. A third column is used to show changes, increase or decrease in figures. The fourth column may be added for giving percentages of increase or decrease. While interpreting comparative balance sheet, the interpreter is expected to study the following aspects: current financial position and liquidity position, long-term financial position, profitability of the concern. For studying current financial position or liquidity position of a concern, one should examine the working capital in both the years. Working capital is the excess of current assets over current liabilities. For studying the long-term financial position of the concern, one should examine the changes in fixed assets, long-term liabilities and capital. The next aspect to be studied in a comparative balance sheet is the profitability of the concern. The study of increase or decrease in profit will help the interpreter to observe whether the profitability has improved or not. After studying various assets and liabilities, an opinion should be formed about the financial position of the concern. Comparative income statement. The income statement provides the results of the operations of a business. This statement traditionally is known as trading and profit and loss account. Important components of income statements are net sales, cost of goods sold, selling expenses, office expenses, etc. The figures of the above components are matched with their corresponding figures of individually and changes are noted. The comparative income statement gives an idea about the progress of a business over a period of time. The changes in money value and percentage can be determined to analyze the profitability of the business. Like comparative balance sheet, income statement also has 4 columns. The first 2 columns are shown figures of various items for 2 years. Third and fourth columns are used to show increase or decrease in figures in absolute amount and percentages respectively. The analysis and interpretation of income statement will involve the following. The increase or decrease in sales should be compared with the increase or decrease in cost of goods sold. To study the operating profits, the increase or decrease in net profit is calculated that will give an idea about the overall profitability of the concern. Common size income statements and balance sheets. The common size statements, balance sheet and income statement are shown in analytical percentages. The figures of these statements are shown as percentages of total assets, total liabilities and total sales respectively. Common size balance sheet. A statement where balance sheet items are expressed in the ratio of each asset to total assets and the ratio of each liability is expressed in the ratio of total liabilities is called common size balance sheet. Thus, the common size statement may be prepared in the following way. The total assets or liabilities are taken as 100. The individual assets are expressed as a percentage of total assets, that is 100, and different liabilities are calculated in relation to total liabilities. Common size income statement. The items in income statement can be shown as percentages of sales to show the relations of each item to sales. Trend analysis. Trend analysis calculates the percentage change for one account over a period of time of 2 years or more. Percentage change. To calculate the percentage change between two periods, calculate the amount of the increase or decrease for the period by subtracting the earlier year from the later year. If the difference is negative, the change is a decrease, and if the difference is positive, it is an increase. Divide the change by the earlier year's balance. The result is the percentage change. Calculation notes. 20 into 0 is the earlier year, so the amount in the 20 into 0 column is subtracted from the amount in the 20 into 1 column. The percent change is the increase or decrease divided by the earlier amount, 20 into 0 in this example, times 100. Written as a formula, the percent changes, percentage is equal to 20 multiplied by 1, amount minus 20 multiplied by 0 amount multiplied by 100 divided by 20 multiplied by amount. If the earliest year is 0 or negative, the percent calculated will not be meaningful. N/M is used in the above table for not meaningful. Most percents are rounded to 1 decimal place unless more are meaningful. A small absolute dollar item may have a large percentage change and be considered misleading. Trend percentages. To calculate the change over a longer period of time, for example, to develop a sales trend, follow the steps below. Select the base year. For each line item, divide the amount in each non-base year by the amount in the base year and multiply by 100. In the following example, 20W7 is the base year, so its percentages, see bottom half of the following table, are all 100.0. The percentages in the other years were calculated by dividing each amount in a particular year by the corresponding amount in the base year and multiply by 100. Calculation notes. The base year trend percentage is always 100.0%. A trend percentage of less than 100.0% means the balance has decreased below the base year level in that particular year. A trend percentage greater than 100.0% means the balance in that year has increased over the base year. A negative trend percentage represents a negative number. If the base year is 0 or negative, the trend percentage calculated will not be meaningful. In this example, the sales have increased 59.3% over the 5-year period, while the cost of goods sold has increased only 55.9%, and the operating expenses have increased only 57.5%. The trends look different if evaluated after 4 years. At the end of 20 into 0, the sales had increased almost 20%, but the cost of goods sold had increased 31% and the operating expenses had increased almost 41%. These 20 into 0 trend percentages reflect an unfavorable impact on net income because costs increased at a faster rate than sales. The trend percentages for net income appear to be higher because the base year amount is much smaller than the other balances. Ratio analysis. The ratio is an arithmetical relationship between two numerals. It is expressed as a proportion or a fraction or in percentage or in terms of number of times. For example, expenses are 70% of sales or sales of current year are 4 times more than that of the last year. Net profits are 1/10 of the capital employed, etc. Thus, accounting ratios are ratios formed out of figures taken from financial statements. These are calculated by placing two figures taken from financial statements in the form of ratio. They are tools in the hands of users and help the management in taking decision. Significance of ratio analysis. Analyzing financial statements from various aspects of a business through the techniques of accounting ratios is called ratio analysis. Ratio analysis is an important technique of financial analysis. It is a means for judging the financial health of a business enterprise. It determines and interprets the liquidity, solvency, profitability, etc. of a business enterprise. Simplification of accounting data. It becomes simple to understand various figures in the financial statements through the use of different ratios. For example, a profit of INR 20,000 may not sound very impressive, but if it is earned with the help of a capital of INR 20,000, it becomes easy to say that the profit is reasonably good by stating that it is 100% of the capital. Accounting ratios simplify, summarize, and systematize the accounting figures presented in financial statements. Helpful in comparative study with the help of ratio analysis, comparison of profitability, and financial soundness can be made between one firm and another in the same industry. Similarly, comparison of current year figures can also be made with those with the help of ratio analysis, and if some weak points are located, remedial measures are taken to correct them. Focus on trends. If accounting ratios are calculated for a number of years, they will reveal the trend of costs, sales, profits, and other important facts. Such trends are useful for planning. For example, if sales of a firm during this year are INR 10 lakhs, an average amount of stock kept during the year is 3 lakh, that is 30% of sales, and the firm wishes to increase sales next year to INR 5 lakh, it must be ready to keep a stock of INR 4.500000, that is 30% of 15 lakh. Selling standards. Accounting ratios based on a desired level of activities can be set as standards for judging actual performance of a business. For example, if owners of a business aim at earning profit at the rate of 25% on the capital, which are the prevailing rate of return in the industry, then this rate of 25% becomes the standard. The rate of profit of each year is compared with this standard, and the actual performance of the business can be judged easily. Study of financial soundness. Ratio analysis discloses the position of business with different viewpoints. It discloses the position of business with the liquidity viewpoints, solvency viewpoint, profitability viewpoint, etc. With the help of such a study, we can draw conclusions regarding the financial health of the business enterprise. Advantages and uses of ratio analysis. There are various groups of people who are interested in analysis of financial position of a company. They use the ratio analysis to work out a particular financial characteristic of the company in which they are interested. Ratio analysis helps the various groups in the following manner. To work out the profitability. Accounting ratio helps to measure the profitability of the business by calculating the various profitability ratios. It helps the management to know about the earning capacity of the business concern. In this way, profitability ratios show the actual performance of the business. To work out the solvency. With the help of solvency ratios, solvency of the company can be measured. These ratios show the relationship between the liabilities and assets. In case external liabilities are more than that of the assets of the company, it shows the unsound position of the business. In this case, the business has to make it possible to repay its loans. Helpful in analysis of financial statement. Ratio analysis helps the outsiders, just like creditors, shareholders, debenture holders, bankers, to know about the profitability and ability of the company to pay them interest and dividend, etc. Helpful in comparative analysis of the performance. With the help of ratio analysis, a company may have comparative study of its performance. In this way, company comes to know about its weak point and be able to improve them. To simplify the accounting information. Accounting ratios are very useful as they briefly summarize the result of detailed and complicated computations. To work out the operating efficiency. Ratio analysis helps to work out the operating efficiency of the company with the help of various turnover ratios. All turnover ratios are worked out to evaluate the performance of the business in utilizing the resources. To work out short-term financial position. Ratio analysis helps to work out the short-term financial position of the company with the help of liquidity ratios. In case short-term financial position is not healthy, efforts are made to improve it. Helpful for forecasting purposes. Accounting ratios indicate the trend of the business. The trend is useful for estimating future. With the help of ratios, estimates for future can be made. In this way, these ratios provide the basis for preparing budgets and also determine future line of action. Limitations of ratio analysis. In spite of many advantages, there are certain limitations of the ratio analysis techniques, and they should be kept in mind while using them in interpreting financial statements. The following are the main limitations of accounting ratios. Limited comparability. Different firms apply different accounting policies. Therefore, the ratio of one firm cannot always be compared with the ratio of other firm. Some firms may value the closing stock on LIFO basis, option, on LIFO basis, while some other firms may value on FIFO basis. Some firms may value the closing stock on LIFO basis, while some other firms may value on FIFO basis. Similarly, there may be difference in providing depreciation of fixed assets or certain of provision for doubtful debts, etc. False results. Accounting ratios are based on data drawn from accounting records. In case that data is correct, then only the ratios will be correct. For example, valuation of stock is based on very high price, the profits of the concern will be inflated and it will indicate a wrong financial position. The data therefore must be absolutely correct. Effect of price level changes. Price level changes often make the comparison of figures difficult over a period of time. Changes in price affect the cost of production, sales, and also the value of assets. Therefore, it is necessary to make proper adjustment for price level changes before any comparison. Qualitative factors are ignored. Ratio analysis is a technique of quantitative analysis and thus ignores qualitative factors which may be important in decision making. For example, average collection period may be equal to standard credit period. Some debtors may be in the list of doubtful debts which is not disclosed by ratio analysis. Effect of window dressing. Effect of window dressing. In order to cover up their bad financial position, some companies resort to window dressing. They may record the accounting data according to the convenience to show the financial position of the company in a better way. Costly technique. Ratio analysis is a costly technique and can be used by big business houses. Small business units are not able to afford it. Misleading results. In the absence of absolute data, the result may be misleading. For example, the gross profit of two firms is 25%, whereas the profit earned by one is just INR 5,000 and sales are INR 20,000, and the profit earned by the other one is INR 10 lakh and sales are INR 40 lakh. Even the profitability of the two firms is same, but the magnitude of their business is quite different. Absence of standard university accepted terminology. There are no standard ratios which are universally accepted for comparison purposes. As such, the significance of ratio analysis technique is reduced. Summary: financial statement analysis or financial analysis is the process of understanding the risk and profitability of a firm, business, sub-business or project through analysis of reported financial information, particularly annual and quarterly reports. The annual report comprises the income statement, the balance sheet, and the statement of cash flows, as well as footnotes to these statements. Analysis means establishing a meaningful relationship between various items of the two financial statements with each other in such a way that a conclusion is drawn. Analysis of financial statements is an attempt to assess the efficiency and performance of an enterprise. Financial statements are documents or reports which have been systematically maintained to indicate the financial health of a company. In trend analysis, the trend percentages are calculated for each item by taking the figure of that item for the base year taken as 100. The ratio is an arithmetical relationship between two numerals. It is expressed as a proportion or a fraction or in percentage or in terms of number of times.